Project 2040, a strategic guide to securing global investment for XRPL-based initiatives, executive summary. This report presents a strategic intelligence framework for MB589 and MG589, two entities operating on the XRP ledger, XRPL, to guide the identification and acquisition of long-term investment partners for a 2040 Horizon initiative. The analysis synthesizes the prevailing macro trends shaping the future of digital finance with a granular examination of the investment landscapes in the Gulf powerhouses of Saudi Arabia and Qatar, and the Western financial superpowers of the United States, the United Kingdom, and the European Union. The global financial system is on the cusp of a fundamental architectural shift, driven by two primary forces: the tokenization of real-world assets, RWAs, and the modernization of cross-border value transfer. The tokenization market is projected to reach multiple trillions of dollars by 2030, representing the single largest value capture opportunity in digital finance for the coming decade. Concurrently, the inefficiencies of the legacy correspondent banking system are creating immense demand for faster, cheaper, and more transparent payment solutions, a domain where blockchain technology offers a proven and superior alternative. This evolving landscape presents a dual-track opportunity. In the Gulf, nations like Saudi Arabia and Qatar are aggressively deploying sovereign capital to achieve ambitious national development goals, as outlined in their respective Vision 2030 plans. For these partners, investment is a strategic tool for economic diversification, technology localization, and the creation of new, non-oil-based industries. The key to securing their partnership lies in aligning with these national imperatives, offering enterprise-grade, compliant solutions that solve tangible economic problems. In the West, the investment thesis is driven by protocol-level innovation and the pursuit of venture-scale returns. A sophisticated ecosystem of crypto-native and traditional venture capital firms is funding the foundational layers of the next-generation internet. Concurrently, regulators in the US, UK, and EU are moving from ambiguity to clarity, establishing comprehensive frameworks like the US Genius Act and the EU's MiCA regulation. This creates a fertile ground for both disruptive innovation and institutional adoption. The core recommendation of this report is the adoption of a tailored, archetype-specific engagement strategy. The XRP ledger, with its unique combination of speed, low cost, proven reliability, and enterprise-grade features, is exceptionally well-positioned to serve both of these distinct investor constituencies. For Gulf partners, the XRPL offers a stable, secure, and compliant infrastructure for building national-level tokenization and payment systems. For Western VCs and institutions, its new EVM-compatible sidechain provides a strategic gateway to the world's largest developer ecosystem, enabling innovation without compromising the performance of its core settlement layer. By understanding and navigating these distinct motivations and regulatory environments, MB589 and MG589 can position themselves not merely as another crypto project, but as the provider of essential, enterprise-grade infrastructure for the future of a tokenized, globally interconnected financial system. Part 1. The Financial Landscape of 2040. Prevailing Macro Trends in Digital Assets. Point 1. The Tokenization Imperative. The next multi-trillion-dollar market. The foundational investment thesis for the next 2 decades in digital finance is the tokenization of real-world assets, RWAs. This is not a speculative trend, but a fundamental architectural evolution of financial markets, driven by the world's largest institutional players. Tokenization, the process of creating a digital representation of a physical or financial asset on a blockchain, is poised to unlock unprecedented efficiency, liquidity, and accessibility across asset classes that have historically been illiquid and fragmented. The scale of this transformation is immense. Leading financial institutions and analysts project a market that will grow exponentially. Larry Fink, CEO of BlackRock, articulated this institutional conviction in January 2024, stating, "We believe the next step going forward will be the tokenization of financial assets, and that means every stock, every bond, will be on one general ledger." This vision is supported by quantitative forecasts. A 2024 analysis by McKinsey projects that the total market capitalization of tokenized assets could reach approximately $2 trillion by 2030, with a potential range between $1 trillion and $4 trillion, a figure that notably excludes cryptocurrencies and stablecoins. Focusing specifically on real estate, which is considered the flagship use case, Deloitte predicts the value of tokenized properties will surge from less than $0.3 trillion in 2024 to $4 trillion by 2035, representing a compound annual growth rate of 27%. The viability of this model is already being demonstrated. Platforms like Realty have successfully tokenized over 535 properties valued at more than $101 million, attracting over 16,000 investors from 100-plus countries. This model, where a property is held in an LLC and investors purchase tokens representing ownership interests, allows for fractional ownership and the distribution of rental income via stablecoins. Similarly, the Spanish firm Riental has tokenized over 95 properties, showcasing the global nature of this trend. While the initial benefits of tokenization are often cited as fractional ownership and enhanced liquidity, the deeper, more strategic value lies in programmability and composability. The ability to embed coded rules directly into a digital token transforms it from a static ownership certificate into a dynamic financial instrument. This allows for the automation of complex processes such as compliance checks, capital calls, and dividend distributions, significantly reducing the administrative overhead for fund managers and asset owners. This operational efficiency is a powerful driver for institutional adoption. The ultimate potential of tokenization is realized through composability, the ability for a tokenized asset to be used seamlessly as collateral within other decentralized finance, DeFi, or traditional financial protocols. This creates a more interconnected and efficient financial system where value can be deployed more dynamically. Consequently, the most valuable blockchain platforms in this future will not be mere ledgers for recording transactions. They will be highly performant, secure, and programmable settlement layers. This reality creates a clear strategic imperative for initiatives on the XRPL to position the platform as a superior infrastructure for creating, managing, and integrating these programmable, compliant assets, thereby elevating the conversation with investors beyond transaction speed to focus on the creation of a new, more efficient market architecture. 1.2. The evolution of cross-border value transfer, beyond SWIFT. The legacy system for global payments, built on a network of correspondent banks and messaging systems like SWIFT, is fundamentally misaligned with the demands of a digitized, 24/7 global economy. It is characterized by high costs, slow settlement times, often taking several days, and a lack of transparency, creating significant friction for international commerce and remittances. This inefficiency represents a massive opportunity for disruption, and blockchain technology has emerged as the leading solution. The improvements offered by blockchain-based payment rails are not incremental, they are transformative. Real-world deployments consistently demonstrate a reduction in settlement times from days to under a minute, with transaction costs cut by 60% to 80%. This is achieved by disintermediating the complex chain of correspondent banks, enabling direct, peer-to-peer value transfer across borders. The market is rapidly moving to capture this opportunity. Projections indicate that stablecoin-based payments alone will grow from representing 3% of global cross-border volume to 20% within the next 5 years, unlocking a potential $60 trillion market. Ripple's on-demand liquidity, ODL service, which utilizes XRP as a bridge asset, serves as a prime case study for this model's effectiveness. It has been successfully deployed in high-volume remittance corridors, facilitating real-time payments and bypassing the need for pre-funded Nostro accounts. Key partnerships include China Bank and Qatar National Bank for transfers to the Philippines, Yes Bank and Axis Bank in India, and Travelex Bank in Brazil. These examples prove the viability of using a digital asset to source liquidity on demand, dramatically improving capital efficiency for financial institutions. However, the future of cross-border payments will not be a monolithic system where a single blockchain replaces SWIFT. Instead, it will be a highly interconnected network of networks. This ecosystem will include domestic real-time payment, RTP systems, such as Hong Kong's FPS and Singapore's PayNow, which are already being linked bilaterally. It will also feature a variety of blockchain platforms, stablecoins, and eventually, central bank digital currencies, CBDCs. This emerging reality suggests that the most strategic and valuable role for a protocol like the XRP ledger is not simply to be another payment rail, but to function as the critical interoperability hub that connects these disparate systems. A protocol that can seamlessly bridge traditional finance, various blockchain ecosystems, and emerging CBDCs will capture immense value. Ripple's decision to launch its RLUSD stablecoin with a multi-chain strategy, issuing it on both the XRP ledger and Ethereum, is a direct acknowledgement of this interoperability-focused future. Therefore, the narrative for MB589 and MG589 should not be one of replacement, an Ethereum killer, but one of connection and integration, positioning the XRPL as the foundational layer that enables value to move seamlessly across the entire global financial landscape. 1.3. The New Financial Infrastructure Stack, a 2040 Blueprint. The financial market infrastructure, FMI, of 2040 will be a hybrid ecosystem, blending the security and reach of decentralized public ledgers with the compliance and control required by regulated institutions. The World Economic Forum identifies the FMI of the future as an innovation leader, integrating technologies like blockchain, AI, and cloud computing to fully digitize financial markets. This evolution necessitates critical design choices regarding the underlying architecture, particularly the balance between permissionless and permissioned systems. Public, permissionless blockchains provide a global, censorship-resistant base layer of trust and are essential for achieving broad network effects. However, financial institutions operate under strict regulatory and compliance mandates, such as Know Your Customer, KYC, and anti-money laundering, AML requirements, which are difficult to enforce in a fully open environment. This has led to a clear demand for permissioned systems or layers that allow institutions to control participation and ensure that all counterparties are known and vetted. The long-term infrastructure stack will therefore be multi-layered. A global settlement layer will provide finality and trust, while specialized permissioned environments will be built on top to cater to specific institutional use cases. This hybrid model is already taking shape. David Schwartz, Ripple's Chief Technology Officer, has explicitly highlighted the concept of permission domains as a key feature for the XRP ledger. These domains would function as controlled zones on the public ledger, where participation is restricted based on criteria, like KYC status, allowing institutions to transact on-chain while adhering to their compliance obligations. This architecture is not a compromise of decentralization, but a strategic feature that makes the XRPL uniquely suited for this hybrid future. It offers a pragmatic solution that preserves the core benefits of public infrastructure, such as shared liquidity and interoperability, while providing the controls that regulated entities require. This is a powerful selling point for conservative institutional and sovereign investors who are often wary of the unregulated nature of purely permissionless DeFi. Furthermore, this new stack will be heavily influenced by artificial intelligence, AI, which will play a crucial role in areas like digital identity. AI can create alternative financial identities based on transactional behavior, leapfrogging legacy credit systems, and promoting financial inclusion, particularly in emerging markets where over 70% of the population is under 35.14. The greatest challenge and opportunity in this new landscape will be interoperability. The current blockchain ecosystem is fragmented, with a lack of standardized protocols creating data silos that limit the potential for seamless value transfer. 12. A platform that can effectively bridge these silos will be a cornerstone of the 2040 financial infrastructure. 1.4 Long-Term Risks ANAP, Strategic Considerations for Blockchain Initiatives. A credible long-term vision requires a sober and transparent assessment of the inherent risks and challenges associated with blockchain technology. Acknowledging these issues up front demonstrates foresight and builds trust with sophisticated investors who are more inclined to partner with ventures that have a realistic understanding of the obstacles ahead. Several key challenges will persist and must be strategically managed on the path to 2040. First, scalability and performance remain a fundamental concern. As blockchain networks grow, their databases expand rapidly, which can impact transaction speed and data storage capacity, making them potentially unsuitable for high-throughput applications without robust scaling solutions. 15-second. Integration with legacy systems is a significant technical and organizational hurdle. The financial world runs on decades-old infrastructure, and interfacing with these systems is complex, costly, and often meets with cultural resistance from established institutions. 12. Third, regulatory fragmentation poses a major operational and legal burden. The legal landscape for digital assets varies dramatically across jurisdictions, with the US, EU, and UK all developing distinct frameworks. Navigating this patchwork of rules requires significant legal expertise and compliance overhead. 6. Fourth, decentralized governance can be a double-edged sword. While it promotes resilience, it can also lead to decision-making challenges, contentious network upgrades, forks, and a lack of clear accountability, which is a significant concern for institutions accustomed to defined governance structures. 15. Finally, smart contract risk is a critical vulnerability. Flaws in the code of self-executing contracts can be exploited, leading to catastrophic financial losses. The immutability of the blockchain means that such errors are often irreversible, making security and rigorous auditing paramount. 12. The ventures that will thrive in the long term are those that adopt a pragmatic, risk-mitigated approach, rather than a purely ideological one. They will prioritize security, predictable performance, and regulatory compliance over unchecked feature expansion. This context allows the specific design choices of the XRP ledger to be framed not as limitations, but as strategic risk-reducing features. For instance, the decision to implement more specialized non-Turing-complete smart contracts, hooks, at the base layer is a deliberate trade-off to enhance security and prevent the kind of unpredictable execution loops that can plague more complex systems. Similarly, the reliance on a federated consensus mechanism, while sometimes critiqued, provides a level of performance and energy efficiency designed for enterprise stability. This approach turns potential technical critiques into powerful selling points for the risk-averse institutional and sovereign capital that will define the market of 2040. Part 2. The Gulf Investment Thesis, Capitalizing on Vision, 2030 and 2402.1. Saudi Arabia, the epicenter of transformation. The Kingdom of Saudi Arabia is undergoing one of the most ambitious economic transformations in modern history, driven by its Vision 2030 framework. This national strategy aims to diversify the economy away from its historical reliance on oil, foster private sector growth, and establish the kingdom as a global hub for technology, investment, and logistics. For any venture seeking partnership or investment in Saudi Arabia, aligning with the goals of Vision 2030 is not merely advantageous, it is a prerequisite for success. 2.1.1 Regulatory Deep Dive, Navigating SAMA, CMA, and Sharia Law. The Saudi regulatory landscape for digital assets is defined by a strategic dichotomy: a highly cautious and restrictive stance on speculative cryptocurrencies, coupled with an aggressive and supportive embrace of blockchain technology as a tool for economic efficiency and innovation. Understanding this distinction is the critical first step to navigating the market. The momentum behind blockchain adoption is undeniable. By the second quarter of 2025, the Kingdom recorded a 51% year-on-year increase in business registrations for blockchain technologies, with the number of active entities reaching 4,005.2. This surge is a direct result of government support and growing confidence in the Kingdom's digital infrastructure. The capital city, Riyadh, has become the undisputed center of this activity, accounting for 2,463 registrations, or 61% of the national total, cementing its status as a regional technology cluster. The primary regulatory bodies are the Saudi Central Bank, SMA, and the Capital Market Authority, CMA. These institutions act as the gatekeepers for the financial sector, employing tools like regulatory sandboxes to allow fintech firms to test innovative products in a controlled environment before a full market launch. However, their mandate also includes maintaining financial stability, which informs their cautious approach to crypto assets. SAMA explicitly prohibits banks from engaging in cryptocurrency transactions without obtaining direct approval, effectively cordoning off the traditional financial system from the speculative crypto markets. In stark contrast, the Saudi government has officially endorsed blockchain as a key emerging technology under Vision 2030, alongside AI and IoT. 25. This support is evident in numerous pilot projects and initiatives across various sectors. As early as 2019, SABB and HSBC completed a blockchain-based trade finance transaction, and SAMA itself piloted the use of blockchain for a SAR 50 billion liquidity injection into the banking sector in 2020 and 2023. The Saudi Customs Authority has also integrated blockchain into its operations via the TradeLens platform to streamline cross-border trade. Overlaying all financial activities is the non-negotiable requirement of Sharia compliance. Islamic finance principles forbid riba, interest, gharar, excessive uncertainty, and maysir, speculation or gambling. Any financial product, including tokenized assets, must be structured to avoid these elements. Successful local fintechs like Lendo and Solfa operate under SAMA's crowdfunding rules using Sharia-compliant structures such as Murabaha, cost-plus financing, and Tawarruk, commodity-based financing. For investment products like tokenized sukuk, Islamic bonds, securing a fatwa, a formal ruling, from a recognized Sharia board is essential to attract capital from Islamic investors. Finally, data sovereignty is a paramount concern. The Personal Data Protection Law, PDPL, and its associated regulations govern the collection, processing, and cross-border transfer of personal data, imposing strict requirements that must be factored into the architectural design of any digital service operating in the kingdom. This regulatory environment creates a clear path for entry. A venture that presents itself as a speculative crypto investment will face insurmountable barriers with SAMA. However, a venture that positions itself as a provider of enterprise-grade blockchain infrastructure for use cases aligned with Vision 2030, such as enhancing trade finance, tokenizing real estate, or improving efficiency in the energy sector, will find a receptive and supportive government apparatus. The narrative must focus on utility, efficiency, and compliance. 2.12 The PIF Doctrine, the ultimate strategic partner. The Public Investment Fund, PIF, is the sovereign wealth fund of Saudi Arabia and the primary engine of Vision 2030. With assets under management exceeding $925 billion, it is not a passive financial investor seeking diversified returns. It is a strategic instrument of national policy tasked with fundamentally reshaping the Saudi economy. Securing a partnership with the PIF requires a deep understanding of its mission, which is to catalyze growth in 13 strategic sectors, create jobs, and localize cutting-edge technology and knowledge within the kingdom. Under the chairmanship of Crown Prince Mohammed bin Salman and the governorship of H.E. Yasser Othman Al Rumayyan, the PIF has deployed capital at an unprecedented scale. 31. A significant portion of its domestic investment is directed towards giga projects like NEOM, a futuristic smart city, and Red Sea Global, a luxury tourism destination. 33. Internationally, it has made high-profile investments in technology leaders such as Uber, Tesla, and Lucid Motors, and has committed $45 billion to the SoftBank Vision Fund to gain exposure to the global tech sector. The PIF's technology strategy is focused on enabling technologies that can be applied across its strategic sectors. It has invested heavily in digital infrastructure, AI, and cloud computing, establishing domestic champions like Saudi Information Technology Co. SITE, and Humane, an AI company developing advanced Arabic language models. At the 2025 LEAP Technology Conference, the PIF announced $14.9 billion in partnerships with global tech leaders, including Lenovo, Databricks, and Salesforce. Despite this aggressive push into technology, the PIF has no publicly disclosed direct investments in blockchain protocols or cryptocurrencies. Its approach is to invest in the application of technology to solve specific problems within its priority sectors, rather than investing in the underlying protocols themselves. The key executive overseeing the fund's global strategy is Turki A. Al-Nawaiser, the deputy governor and head of the International Investments Division. Engaging the PF requires a narrative centered on strategic alignment. A successful pitch would not focus on the investment potential of XRP, but on how a solution built on the XRP ledger can accelerate the achievement of Vision 2030's goals. Potential angles include trade and AMP, logistics, presenting a platform that streamlines cross-border trade and supply chain management for the kingdom's growing industrial and logistics sectors. Real estate and AMP, tourism, proposing a system for the tokenization of assets within the Giga projects, enabling new models of investment and ownership. Financial services, demonstrating a Sharia-compliant, blockchain-based financial infrastructure that can enhance the efficiency of the Tadawul, the Saudi Stock Exchange, or the broader banking sector. The PIF seeks partners who can contribute to its core mission of economic transformation. A proposal from MG589 must be framed as a joint venture in building the future of the Saudi economy, with technology localization and job creation as central pillars of the value proposition. 2.1.3 Engaging the Saudi venture and AMP family office ecosystem. Beyond the colossal scale of the PIF, Saudi Arabia boasts a rapidly maturing and dynamic ecosystem of venture capital firms and sophisticated family offices. These entities represent a crucial layer of the investment landscape, often acting as early-stage partners, market validators, and conduits to the broader commercial and regulatory environment. The venture capital scene is heavily concentrated in Riyadh, which has become a magnet for both local and regional funds. Leading firms include Raid Ventures, an early-stage firm with a strong focus on the MENA region. Its portfolio demonstrates a keen eye for fintech, with notable investments in companies like Lean and Open